Welcome to this explainer. Okay, if you're a retail investor trying to navigate the whole Indian auto sector right now, you've definitely heard the buzz around TVS Motor. We're going to put on our financial detective hats today and dive deep into their FY26 financials. Does this century-old mobility giant actually fit the profile of a rock-solid long-term growth stock? Well, we're going to look past the headlines, break down the raw numbers, and see exactly what's under the hood. We'll be using this due diligence checklist today, working our way from top-line revenue surges all the way down to actual stock performance and outlook. All right, let's dive into this. To answer our core question, we really have to look at the raw data and see if the company's financial DNA actually supports the hype. As retail investors, it's so easy to get caught up in a brand's legacy. But a true long-term growth stock, it needs to show persistent, forward-looking momentum. We want to see expanding market share, scaling profits, and a very clear reinvestment strategy. So let's see if TVS Motor passes the test. Section 1, Sales and Revenue Surges, Record-Breaking Top-Line Growth. So the absolute most fundamental question for any manufacturing business is simple. Are they actually growing the core business and selling more vehicles? The answer here is a resounding yes. Consolidated revenue for FY26 jumped an impressive 27% to roughly 56,070 crore rupees. That is a massive scale-up for a company of this size. And it wasn't just a lucky quarter early on. The momentum actually accelerated. Q4 alone, so January to March 2026, surged over 30% year-on-year, bringing in about 15,026 crore. And that momentum carried right over into the new fiscal year. Look at May 2026. They hit an all-time record of 5.67 lakh units sold. That's a 31% jump year-on-year. But what's absolutely crucial for us to understand is where this growth is coming from. It's being heavily driven by international expansion, and crucially, their EV sales crossed 44,000 units for the month. They aren't just selling more of the same stuff. They're successfully scaling in the categories of the future. Section 2, Profits and Premium Valuations, the bottom line and the price tag. Now, it's awesome to sell more bikes, but we need to see if they're actually making more money doing it. And this number is exactly what you want to see. TVS Motor's full-year net profit for FY26 hit a massive 3,018 crore. That marks a 35% increase from the previous year. Do you notice something important there? Profit growth at 35% is actually outpacing revenue growth at 27%. That means the company is getting more efficient as it scales up, with operating profitability running consistently around 10 to 11% of sales. But hey, the market isn't blind to this profit growth. With trailing 12-month earnings per share at 63.6 rupees, the stock is trading at a PE ratio between 45 and 56 times. And it's got an EV to EBITDA multiple of around 24 times. Make no mistake, the market is slapping a premium price tag on this one. As an investor, you just have to acknowledge that you're not buying some cheap, undiscovered value stock here. You're paying a premium because everyone is clearly pricing in continued aggressive high growth. Section 3, Debt Fueling Future Growth. Reinvesting for the future. All right, this is where we separate the casual observers from the real financial detectives. Here's kind of a classic financial paradox. We just confirmed they're generating soaring, record-breaking net profits of over 3,000 crore. Yet at the exact same time, they have negative free cash flow on a trailing basis, and their net debt has actually risen from about 18,850 crore up to around 25,800 crore recently. How on earth can a company be so wildly profitable, yet be burning cash and taking on more debt? Well, the answer lies in a classic growth phase pattern. TVS Motor actually has a massive cash pile of roughly 5,020 crore sitting in the bank. But instead of hoarding it like a dragon guarding its gold just to make their free cash flow look pretty for short-term traders, they're actively redeploying it as growth fuel. They are pouring capital into capacity expansion, building out new manufacturing plants, and heavily funding their EV tech scale-up. Basically, they're playing the long game. Let's break that debt down a bit further, because a debt-to-equity ratio of 3 times can definitely sound like a red flag at first, but context is everything. A very meaningful part of this 25,800 crore debt isn't for manufacturing at all. It's capital being used by their vehicle financing subsidiary to lend out to two-wheeler buyers. So they borrow money to lend it to customers who then buy their bikes, earning interest along the way. When you strip out that financing arm, the core manufacturing debt profile actually looks entirely different and much, much healthier. Section 4. The ownership breakdown. Who controls the wheel? If you're going to put your hard-earned cash into a company with a market cap of around 1.65 to 1.7 lakh crore, you really need to know who's in the driver's seat. The ownership breakdown reveals a powerful story about market confidence. First, the promoter holding, the TVS family and group entities, is at 50.3%. That implies firm majority control and stability. Next, you have over 40% held by institutional investors, foreign at 22.5%, and domestic at 18.5%. That shows massive smart money confidence, and that leaves a highly exclusive float of just 8.7% for retail investors like us. It's a tight, institutional heavy holding pattern, which typically acts as a really strong shock absorber for the stock price. Section 5. Shareholder Rewards and History. Corporate Actions Over Time. Okay, we've seen the profits and the growth, but how has TVS Motor historically rewarded the folks actually holding the shares? If you're an income-focused investor, the immediate reward might seem a bit modest. The recent FY26 dividend was 12 rupees per share, yielding a low 0.3%. But remember that growth phase pattern we just talked about? This low yield is totally typical for a company reinvesting heavily into its own future. But looking back, they executed a stock split in 2003, and then both a bonus and a split in 2010. Since then, the share price has climbed back into the thousands without another split. And that's exactly why long-term investors are watching the space very, very closely. Section 6. Stock Performance and Outlook. Outperforming the market. Because look, all the financial engineering and sales growth in the world doesn't really matter to us if it doesn't translate to the stock chart, right? Fortunately, it absolutely has. Trading near the top of its 52-week range, around 3,500 to 3,600 rupees recently, the stock has comfortably outperformed a broader Sensex that's been under quite a bit of pressure. Depending on your exact measurement window, shares are up an impressive 18 to 27% over the past year. This isn't just a stock riding on vague market sentiment, it's being propelled upward by those genuinely strong underlying operating numbers we just reviewed. So, to sum up this explainer, as we look at our completed checklist, TVS Motor shows all the classic hallmarks of a long-term growth stock. We've got top-line revenues surging 27%, an even sharper jump in profits at 35%, a highly strategic approach to debt and reinvestment, rock-solid backing with promoters and institutions holding over 90% of the company, and market-beating performance to top the whole thing off. But hey, the market is forward-looking, and so are we. Given the premium valuation that is already pricing in a lot of this massive growth, this is the pivotal question you should take away today. Is their aggressive pivot into electric vehicles and the expansion of their vehicle financing arm the true catalyst that's going to secure their dominance for the next decade? It is a fascinating business case, and if you're keeping an eye on the Indian mobility revolution, TVS Motor is undoubtedly a story worth watching. Thanks for joining me on this explainer, and keep learning. Okay, let's dive right into one of the most explosive stories in the auto sector this year. Welcome to this explainer, where we're going to peel back the layers to see exactly what is under the hood of TVS Motor. For anyone keeping an eye on stock market potential, this right here is a masterclass in corporate acceleration. We aren't just looking at a company that makes bikes, we are looking at a highly engineered growth engine. 35%. Just think about that number for a second. In the financial year 2026, this company posted a massive 35% jump in net profit. In an industry literally known for its tight margins and heavy capital expenditures, seeing the bottom line expand by over a third in a single year, that is a massive signal for investors. And, well, naturally, that bottom line surge absolutely fueled a 27% stock rally over just 12 months. But what's truly incredible here is that TVS achieved this while totally defying broader market struggles. While other sectors and competitors were out there navigating some pretty tough economic headwinds, TVS was quietly breaking out and seriously rewarding its shareholders. But look, as investors, we know the market is always forward-looking, right? It is all about the future. And looking at that future, their electric vehicle sales have completely skyrocketed by 56%. They aren't just succeeding in legacy vehicles anymore, they are rapidly capturing market share in the literal next generation of mobility. Which brings us to the million-dollar question for any potential investor looking at these figures: what is actually driving all this massive growth? Is this just temporary good luck, maybe a post-pandemic bump, or are we looking at a perfectly engineered growth machine that's built to compound wealth over time? So, to answer that, we're going to tear this growth engine down piece by piece. We'll cover the immediate catalyst, their century of resilience, the high-margin revenue ecosystem, their winning brands, and finally, their global scale. Let's kick things off with Section 1, the catalyst, the financial milestones driving the current momentum. The top-line numbers here are just staggering. I mean, in FY26, TVS crossed 56,070 crore rupees in annual revenue, and that propelled them to a 1.65 lakh crore market cap. To put the sheer volume of this business into perspective, in May 2026 alone, they sold over 5.5 lakh vehicles. That is a 31% jump year over year in a single month. This right here is the immediate catalyst that grabbed the market's attention: massive scale combined with a seriously accelerating sales velocity. Moving on to Section 2, a century of resilience, going from bullock carts to a global auto giant. Now, to really trust this kind of momentum, long-term investors need to see resilience. And TVS, they have a literal 100-year track record of it. This is a company that constantly pivots and adapts. I mean, they started way back in 1911 with a motorized bus service in Madurai when most of India was still using bullock carts. They built India's first two-seater moped in 1980. They partnered with Suzuki to learn global standards, and then confidently went fully independent in 2001. And more recently, they acquired the legendary British brand Norton and launched their EV, the iQube. For an investor, this proves you have a management team that continually compounds its operational expertise decade after decade, successfully navigating basically every technological shift. All right, Section 3, the revenue ecosystem. Let's see where that high-margin cash flow actually comes from. Because, this business is far more than just selling bikes. You have the core manufacturing of 2- and 3-wheelers, sure, which provides the volume, but then you've got spares and services, financing, and subsidiaries. This diversified approach is a massive green flag for investors because it protects the company from single market shocks. If vehicle sales take a temporary dip, those other layers step up and keep the cash flowing. So here is the crucial point for your wallet. And honestly, the real secret to that 35% profit jump, it's the contrast between one-time volume sales and recurring revenue. Think about it. When TVS sells a motorcycle, that's a one-time transaction. But the spares, the after-sales servicing, the financing, that is high-margin, recurring revenue that keeps the balance sheet incredibly healthy long after the vehicle actually leaves the dealer lot. It effectively turns a single customer into a multi-year cash stream. And when you look at the specific growth drivers, wow, EV sales are up 56%, three-wheeler sales are up 55%, and international sales are up 49%. These three categories are absolutely supercharging their top line. They're capturing growth in commercial transport, global markets, and next-gen electric mobility, all at exactly the same time. Next up, Section 4, winning brands and innovation, how they're driving that premiumization strategy. This step-by-step premiumization strategy is honestly brilliant for capturing every single type of rider out there. Just look at how they structure the brand journey. Step 1, get them in with reliable mass-market commuters like the Jupiter or Raider. Step 2, as that customer's income grows, upgrade them into the youth and performance categories with the N-Torque, Apache, or Ronin. And then Step 3, capture the top tier with the BMW tie-up, Norton, and the electric iQube. For an investor, this latter means they bring riders in at the entry level and smoothly upgrade them into high-margin performance and EV categories over their entire lifetime. But here's the thing. You absolutely cannot charge a premium with quality to back it up. TVS is actually the first two-wheeler manufacturer in the world to win the Deming Prize for quality. This obsessive focus on quality is the absolute bedrock of their R&D. And for an investor, high quality means lower warranty claims, higher customer retention, and way better brand pricing power. It proves they don't just build fast, they build to last. And they definitely aren't just resting on their laurels either. In 2025, they acquired Engines Engineering, which basically injected elite Italian design capability directly into their innovation pipeline. They are aggressively going after global design talent to stay ahead of the curve. They're making sure their next generation of bikes isn't just mechanically sound, but aesthetically world-class, which is exactly what you need to dominate the premium market. Finally, Section 5, Global Reach and Scale. De-risking through geographic diversification. As an investor, you know the golden rule. Never put all your eggs in one geographic basket. TVS completely de-risks their business model by expanding their footprint all across the globe. They now export to more than 80 countries, making them the second largest two-wheeler exporter from India. They've built a massive presence in Africa, the Middle East, Southeast Asia, and Latin America. And that's all backed by strategic corporate offices in the Netherlands, Singapore, and Dubai. This expansive network means that even if the domestic Indian market experiences a slowdown, their international sales, which, remember, recently grew that 49%, can easily pick up the slack and keep those earnings perfectly stable. But to fuel that kind of global demand, you need serious scale, right? Well, TVS operates 4 massive manufacturing hubs. 3 are across India in Hosur, Mysore, and Nalagarh. And they have a vital overseas plant in Karawang, Indonesia, which gives them direct, tariff-friendly access to Southeast Asian markets. Together, these facilities pump out an annual capacity of over 4 million two-wheelers. They already have the physical infrastructure in place to support their aggressive growth targets, meaning they don't need to constantly dilute shareholder value just to build new factories. So we've torn down the engine, we've seen the 100-year legacy of adaptation, the high-margin recurring revenue ecosystem, that brilliant ladder of premium brands, and the massive de-risked global scale. Which really leaves us with the ultimate investor question. With all this growth already priced in, does TVS Motor stock still have room to run? Consider how their EV and international segments are just now hitting their stride. It's a fascinating question for sure, and one you'll definitely want to keep firmly in mind as you watch the auto sector this year. Thanks for joining me on this explainer, and keep learning. Welcome back, focused learners. Today on The Explainer, we are literally popping the hood on a true automotive powerhouse. We're looking deep inside TVS Motor Company to analyze its actual growth drivers, the seriously fierce competition it's facing, and of course, the underlying risks for anyone looking at this from a potential long-term investor's perspective. So if you want to know what's really driving the financial numbers for this giant, you are in the exact right place. Okay, let's dive into this. Think of our roadmap today as your visual investment prospectus. We'll be treating TVS Motor Company almost like a multi-cylinder engine. We're going to check out their electric growth engine, their global expansion, compare them against the competition, weigh the pretty heavy risks involved, and finish up with some crucial valuation takeaways. All right, Section 1, the electric growth engine. This is absolutely what is pushing TVS forward into the future and completely reshaping their business model. Our source analysis actually kicks off with a really bold statement. It says, TVS Motor is a classic example of the market paying a premium for a company with multiple growth engines firing at once. And you know what? We're going to look at these engines one by one, starting right off with their electric vehicles. 1 million. Take a second to let that sink in. That massive number represents the cumulative electric vehicle retail sales in India for TVS, which is mostly driven by their iQube and newer Orbiter models. I mean, at their peak, they were hitting an incredible 44,000 deliveries in a single month. This isn't just some experimental side project anymore. This is a massive, tangible shift in their core business. And looking at the broader picture, among the established legacy players in the EV space, TVS holds a whopping 28% share. But here is the absolutely crucial point for a potential investor. Management indicates that EV operations are now actually contribution positive. Yep, thanks to production-linked incentive benefits, EVs are finally generating profit per unit sold. They aren't just dragging down the bottom line like a pure cash-burning investment story from a few years ago. It's a real game changer. Moving right along to Section 2, global expansion and brands. This second major growth engine is all about scaling up manufacturing and, surprisingly, the revival of a legendary motorcycle name. So TVS is executing a wildly aggressive capacity expansion roadmap. Right now, they're sitting at 6.8 million in annual capacity, but they plan to add another 1.5 million units over the next 12 months, bringing them to roughly 8.3 million units annually. But what's really fascinating is where that capital is flowing. It's going into digital capabilities, their in-house financing arm, and heavily into the revival of Norton motorcycles. TVS acquired this classic British brand back in 2020, and they're expecting new premium models like the Atlas and Atlas GT, with production split between the UK and India, to start bringing in meaningful revenue by the second half of financial year 2027. Now, beyond domestic manufacturing, exports remain a totally core growth pillar for them. In fact, their international business is consistently outgrowing domestic sales, with super strong demand across Latin America, Africa, and Southeast Asia. And here is a fascinating strategic advantage that you might not immediately think of. Their direct exposure to the Middle East is under 1%. That is huge, because it significantly limits their vulnerability to any volatile geopolitical disruptions in that specific region. Okay, Section 3, comparing the competition. It's time to check the rearview mirror and see exactly where TVS stands against its really fierce Indian and global rivals. And this brilliantly illustrates just how fierce that competitive battlefield is. You've got Hero MotoCorp holding the #1 spot in domestic volume with their massive rural scale. Then there's Honda showing the sharpest growth momentum and actively closing that volume gap. But Bajaj Auto? Well, they're the undisputed export leader. But TVS Motor is kind of unique here. While they are third domestically, they actually recently passed Yamaha to become the third largest globally by overall volume. How'd they do it? By growing across nearly every single segment simultaneously, from EVs and budget scooters all the way to premium exports. Section 4. Weighing risks and opportunities. As potential long-term investors, we absolutely need to balance all this growth hype with the fundamental warning lights that might be flashing on the dashboard. So let's look at it. The growth opportunities are pretty clear, right? Expanding EV penetration, the Norton Global Premium push, strong diversifying exports, and rural demand that's getting a nice boost from recent tax and GST benefits. But the risks are equally stark. TVS faces severe commodity inflation, especially for steel and those super important rare earth magnets needed for their EV motors. There's also rising debt tied directly to that massive capacity expansion we talked about. Plus, they face heavy execution risk taking Norton up against heavyweights like Triumph, BMW, and Ducati. Oh, and all of this while constantly fending off disruptive EV players like Ather and Ola Electric. Summarizing this whole business layout with a classic SWOT analysis, TVS has some rock-solid foundational strengths. We're talking 100-year legacy, high return ratios, and genuine EV leadership, perfectly matched against opportunities like export diversification. However, their primary weaknesses are a really premium valuation and rising leverage. Also, definitely note the low dividend payout. If you're an income-focused investor looking for regular, reliable cash flow, this specific stock setup honestly might not suit your strategy. Finally, Section 5, Valuation and Investor Takeaways. We're going to look strictly at the numbers now and lay out exactly what you need to be monitoring moving forward. So, TVS Motor is currently trading at a trailing price-to-earnings, or PE, multiple of 45 to 56. Now, if you know the traditional auto industry, you know that is a highly, highly premium valuation. You are paying a premium price for their current earnings, putting them well above many of their traditional auto peers. And while brokerages do have price targets ranging from 3,950 to 4,800 rupees, which implies some moderate upside from current levels, the absolutely crucial point to understand is that this stock is practically priced for flawless execution. The market is quite literally pricing in perfection here. If there is even a tiny stumble in their EV rollout, or if that Norton revival hits a speed bump, well, the stock could take a really hard hit. Premium valuations leave almost zero margin for error. Because high-growth stocks require active monitoring, you're gonna need to do your homework. Watch their latest quarterly results closely. Track their valuation against historical peers. Keep an eye on debt trends and how they deploy capital, and intensely monitor their execution on Norton and EVs. And of course, always assess your own personal risk appetite and time horizon. Just a quick, strict reminder though, this explainer is purely for educational and informational purposes only. It's definitely not investment advice or a recommendation to buy or sell any stock. Always consult a registered financial advisor before making moves. Which leaves us with one final, totally pivotal question. Does the promise of multiple growth engines truly justify a premium price? That is the exact puzzle you need to solve as an investor. I highly encourage you to dive into your own research and decide for yourself. Thank you so much for joining me today. If you love efficient visual